Hello, everybody, and welcome to Get Real with Morton. And today I'm joined by Nick Frankel, who runs our leasing and new business team here. And his job is to lease things. And he's been doing it for a very long time. Has been with Morton for 20 years.
Yep.
We love that.
That's good.
Warm and fuzzy. And so no one knows more about that market than Nick does. So we're going to talk about the impact of it. Interestingly, I suppose there's a few paradoxes in the market, as in that rentals are going up, but it's not necessarily attracting investors. So we're going to talk about why that is. So the first thing, rents after COVID, everyone forgets. COVID, rents collapsed.
They did.
And they collapsed. And then it took a number of years for them to get back up again.
That's right.
And now we've gone a completely another trajectory where things have taken off.
There's all sorts of things happening at play, many factors that bank it up. But really what it's coming down to is the classic of supply and demand. That's really that underpins the whole thing. So what we're seeing is a contraction of the supply in the marketplace. We're seeing less investors buy up property now than what we used to, more owner-occupiers, which is less available stock in the marketplace. And then we're seeing tenants also just stay longer in those properties. So from a tenant perspective, there's also less on the market for them, not just for the investors to buy, but also for the renters to rent.
So Nick, are rental yields improving? Because obviously you talk about undersupply we need more investors in the market. So what's happening with rental yields?
Well, look over time, and what used to be the classic was 5%. That's what we all used to look for. If it rents for $500 a week, you're going to buy it roughly for $500,000. We're starting to sort of get back to that because it went and dropped right off, where all of a sudden 2.7, 3.5 was the norm. And what that meant is that you heavily relied upon that capital growth piece to make your money, and you take the hit while you waited.
And what a lot of people wouldn't necessarily realise is that there has been a crunch on certain types of property in Sydney where capital values have come down and the rents have increased. So those rental yields are improving, but it's coming with a dose of pain for the current landlord group.
Yeah, and look, I think anybody that's looking to buy an investment property, all the fundamental stuff still applies. Where is it in proximity to schools, shops, transport? You cover off those things, very good chance that from a capital value perspective, it will keep moving, but it's going to attract the right tenants as well because they're looking for the same thing.
And we couldn't really have a discussion about the rental market without talking about interest rates, because obviously for tenants, they're really feeling the pain of this increased rents, but landlords have really felt the pain of the increased interest rates. And we've had this situation where even though rents have gone up a lot, interest rates went up even more.
That's right. There's been pain on both sides.
Yeah.
There's absolutely no doubt. And I'm not saying for a minute that poor old landlord, right, or poor old tenant, but we're all in this together ultimately, and one will affect the other one. So the banks put it up. Hey, the rents have to go up. It's just how it goes. But all signs are pointing towards the Reserve Bank to seeing a few more interest rates go down this year, which is great news for investors and I suppose great news for renters as well, because there wouldn't be such a pressure to put up those rents.
Well, and I suppose also the big issue that everyone keeps talking about in Sydney is undersupply. Obviously, we've seen all of this rezoning that's gone on, but it's not only about increasing the supply, it's also attracting the investors who want to be in the market, and they've been largely absent from Sydney.
They really have, and we've noticed that over time with a lot of the work that we do. We used to see basically a 50-50 split in terms of the investor versus the owner-occupier going into those buildings, to the point now where it's 80-20, 70-30, depending on what the project is and the profile of people that they sold those things to. But typically, the higher the value of those properties, the less likely that we're going to see investors buying them.
So less pool. So very interesting. So obviously we've touched on undersupply with investors not being in there, but and we also touched on the planning, changing that. We have had heightened immigration into Sydney. So same stock effectively, higher immigration, and particularly the university students. Are you seeing that affecting the market at the moment?
100%, and it depends on the time of the year. So at the beginning of the year, it pulses. So if you've got vacancy coming up anytime from January through to March, right, that is the prime university time. And what we see in Sydney market is lots and lots of international students coming through on that, not just our local or domestic ones. Typically, the local kids They stay at home because they can't afford the rents. But the international students, a different story. So there's risks associated with that as well. With your international students, typically those leases are around about 9 months, not the full 12. Even if they take the 12, likely lease break at month 9.
And let's touch on the short-term rental market, because I think this is a bit of a sleeper where it's so much more accessible to do short-term renting on your property. Do you think that that is taking stock out of the long-term market?
100%. It does. It all has that net effect ultimately. But again, that pulses and surges, and our experience with those landlords, they do like the sugar rush of those high rents with the short term, but it does typically come with a larger vacancy period because the occupancy does fluctuate. It's a lot more effort to do it because you've got linen and all the other pieces that go with it, and it's a bit of a headache for a lot of people. What we find is that they would prefer to go with, in a lot of instances, they go with the long-term tenant, give me the 6, give me the 12-month lease. So much simpler, and I don't have to worry about replacing furniture and all the complication that goes with that.
So obviously vacancy rate's a big deal. Talk about that a lot. We measure ourselves against it. We always like to be below what's been reported as a
100%.
market statistic. We get a good result here at Morton Real Estate. Thank you, Nick. But the vacancy rate, it is historically
2%.
an all-time low.
So for inner Sydney at the moment, the city ring, it's 2%, and we're kicking off at 0.876 or something like that. So less than 1%. And even for us, that is different. We do typically track just below the Sydney vacancy rate, but at the moment for us, we're less than half of it. So clearly we're trying to do a good job for our customers, but potentially we are a lead indicator for vacancy drops that are coming further down the line as the larger market starts to report
Well,
it.
when you're reporting an under 1% vacancy,
It's
from
uncommon.
a landlord perspective, there is going to be more increases coming. How can it not? But one of the interesting phenomena that we have noticed in the last few months is that rate of growth has slowed somewhat. A little bit. It's interesting talking to the leasing consultants who maybe have not experienced a bad market. I'm like, this is still great. But it has slowed down a bit. What do you think that's about?
Look, affordability is really what it comes down to. I think we are now finally at a time where the tenants just can't afford to pay more. There's only so much money that somebody's going to go and pay for a 2-bedroom that doesn't have a view in an old building down in Surrey Hills. There is a limitation to this, and I think that's what we're feeling now.
I just can't pay any more. We've got maximum out of them.
Pretty much.
No, it's very interesting. So, Nick, we've discussed the aspects of the rental market right now. What do you think 2025, the rest of 2025 is looking like?
Hooah. Look, I think it's going to be more of the same. I think we're not going to see any wild swings in stuff where even if we do see those interest rates go down, I don't think the landlords are necessarily going to put their rents down to track with it. It's just going to be a period of prosperity ultimately for those landlords as they pay less in their interest, so their net yield's going to be much better. I think that rents will continue to creep up, that 1 to 5% range, depending on the property and where it is and how that sort of looks, just because our rate of inflation and everything else that's running with it will continue, but it's not the crazy boom times that we found immediately after COVID, because that was unprecedented.
But pretty solid.
It's going to continue.
I think it's going to be pretty solid until they fundamentally get that supply increased. I really think for someone who is renting a property in Sydney, the rents are going to continue to be pretty good.
100%. Real estate will continue to be a great investment. There is absolutely no doubt about that, and all the signs are pointing towards, for the next 5 years or so, that will be the case.
Great. Well, there you have it. Hey, continue to be a landlord. That's the message. And continue to have it managed by Morton. That's the message as well. But thank you to Nick for giving us those insights. That was interesting. See you next month.